Good evening to you all, and welcome to the 15th episode of Market Replay. If you are tuning in for the first time, I am your host, Koketso Ditlakanyani, founder and chief technical analyst at ACE Forex Academy. Just to shed some light on what I seek to achieve through the delivery of these videos, and that's just simply to share with you my perspective and the different ideas that I have regarding how to trade currency pairs, right? And how I will be doing that is that I will be looking at a day's worth of price information in the form of candlesticks. And from that information, I will then be extrapolating the different areas of opportunity, and then I will be going into depth and giving an understanding of how we could have traded those different opportunities that were presented to us. Right? To not waste any further time, for today's episode, we will be looking at the United States dollar against the Canadian dollar, and this will be market data for the 28th of July, which was this past Tuesday. Okay, let's start. So as you have picked up from all the other previous episodes, what I then do is start by highlighting the trend, right? We're trying to understand the movement of price throughout the day, and from there we will then be extrapolating the different areas of opportunity, right? The day started off bearish. The bears continued, but that momentum didn't last very long, with the bulls then kicking in and pushing price higher, giving us our higher lows and higher highs. In this particular situation, we then had a brief pause, right? And like how I explain in all the different other videos, is that where we have areas of consolidation, that's where we have our pause, and those pause areas are very important to us because that's where opportunity to join the trend exists. Okay, you don't want to join an uptrend at its peak, and you don't want to join a downtrend and it's at its bottom. Okay, you want to wait for trend to take a bit of pause, let steam gather, and then you continue with the movement of the trend, right? So that's simply what this area of consolidation represents. Okay, continue to mark. Then we had a second area of consolidation, which I will mark out here before the breakout, right? And the bulls then kept pushing price higher. This was the final push, and trend then finally changed to the downside. But soon after changing to the downside, we were then presented with another area of consolidation, okay? Or a pause, right? So it's our pause, and then price then continued to push to the downside. Okay, continue to push with trend then changing, and our day ending off on a slight bullish turn, right? As we can see, we have 3 periods of consolidation. Let's just zoom into them and understand how we would have traded these particular situations, right? So we'll start off with our first area, which is this area over here. Okay, let's move on down to a lower time frame. Let's have a look, right? So like I always say with the videos that I post, we always start on our left, right, in order to understand the history of price, right? So starting on our left, we have the formation of a swing high. Okay, and what does the swing high then indicate to us? It indicates to us our level of resistance. Okay, and this level of resistance then further goes on to highlight that this is an area of supply. Okay, so what we want to remember is that at areas of supply, that's where we have sellers parked, right? Because the price is assumed to be very expensive, and therefore sellers want to then sell and generate a profit from that. Okay, so that's what we have represented over here. Now with that understanding, we can then move on and pull our Fibonacci tool. Okay, let's have a look. Forecast this entire move to the upside. Okay, and remember, with our strategy, what we are interested in is a close below 50% retracement, right? And that's what we have with this bearish candlestick over here, and that then indicates to us that we needed a close past this high before we could join the trend and continue, right? So let's then reforecast our Fibonacci tool. There we go, right? But now, as you can see, this is very interesting. This particular close, confirmatory close that we have from this bullish candlestick, closes within our resistance zone. Okay, and because of that, we did not take this particular trade, all right, because there was no room presented for us to then forecast our minimum profit target, which is a 1:1 risk reward ratio. Okay, so we did not take this particular trade because the close of this bullish candle was on our turning point, or what was considered our turning point when we're looking at history, right? And as you can see, the close happened, price pushed back down, and if you then insisted and continued to argue with the markets and took the buy, you would have then been stopped out by this bearish candlestick over here, right? And price then went on to do the same thing. Okay, so as we can see, this is a no trade situation and we did not take this particular trade. Okay, now let's move on to the next area of consolidation, which is this one over here. Let's have a look. Let me just erase this. Same story applies, right? Same method, same standard operating procedure. Start on your left, and after starting on your left, what you then do is highlight your area of resistance coming from the swing high, right? This is our area of resistance that we have. Okay, and what does our area of resistance tell us? It tells us that sellers are parked because this is an area of supply. Why? Because price is considered to be at a very expensive price, so sellers want to then sell and capitalize on the move to the downside. Okay, with that understanding, let's pull out our Fibonacci, forecast this entire move. Remember, we are looking for retracements that close well below 50%, and we can see that we have our criteria met with this particular bearish candlestick over here, right? And now let's have a look. What that then indicated to us is that in this particular situation, we needed a close past that high. Okay, right, now let's pull out our Fibonacci tool and just forecast. Okay, with that close over there, right? What we can then see in this particular trade is also interesting because number one, right, our 1:1 risk reward, a minimum risk reward target, is above our resistance zone. Okay, now that gives us a heads up to not take this particular trade. However, what we can then see is that our 50% level, right, sits within our resistance zone. Okay, so this provides a good scalping opportunity, right? However, the odds are not in your favor because should you be stopped out, you are then going to lose more than what you had expected to make from this particular move, right? But of course, with opportunities such as these, there are various ways in which you can trade them safely, right? So in this particular case, you could have taken the buy right on the close of that candle, and immediately when price hit the 50% level, you then had price move up and place a positive stop. Okay, and after placing a positive stop, you would have then walked away with a good 1:1 risk reward ratio return, and then price then further pushed up to give you 1:2. Okay, and that's that simple. However, we did not take this trade because what we are interested in is having our minimum risk reward target set before our support or resistance zones. Okay, so that probability sits on our side and we know that there are higher chances that the trade is going to work out. Right, let's move on to the next one, and this is our last consolidation zone. Right, let's move lower. Just remove this. Right, same as always, what do? Start on your left. Okay, standard operating procedure. Right, what does the left give you? Gives you an area of support. Right over here. And what does our area of support then tell us? Our area of support then tells us that we have buyers parked within this particular region of the market. Right, why? Because price is considered to be cheap enough to entice or to offer incentive for buyers to then join the market. Right, it's seen as a fair price. Okay, you never want to buy something when it's too expensive. You always appreciate a good discount on the good that you are buying. So the CFD is the good we are buying, and buying at the area of supply or our support zone. Right, the area of demand, sorry, buying at the area of demand, all right, or our area of support. Okay, then gives us that incentive to enter the market because we see prices being fair. All right, with that understanding, let's pull out our Fibonacci tool and let's focus the move to the downside. Okay, what we are interested in is closes above the 50% level. Okay, and with that understanding, we then see that we needed a close past this low over here before we could enter the market. All right, let's pull out the Fibonacci tool again. There we go, and there's our closing candle. Right, same story as the previous setups that we had. Our 50% region set within our zone, right, but our minimum that we aim for, which is 1:1, and the extended one is 1:2, are far beyond our zones. Right, so in this case we did not take this particular trade. Right, it was not a good enough setup. It was not meeting or allowing us to check off the boxes. Okay, so we did not take this particular setup. All right, and that's how we would have approached this particular trading scenario. Okay, always be wary of your zones. Right, be careful of them. Don't always fight them because they do have a high probability of turning price around. Okay, let's move on to the larger time frame and have a bigger picture. Right, to sum it up, what we can then see is that we had good changes in trend on the United States dollar against the Canadian dollar. However, we were presented with 3 trading opportunities and none of them worked out, simply because they did not meet our criteria that ensured that we walk away with the minimum profit target of achieving a 1:1 risk reward ratio. Right, so in that case, that's how we approached the USD CAD. It was a good day. We had setups shown to us. However, there were no confirmations. Right, there were no incentives to join the trades, so we missed all 3 opportunities. Okay, and that happens. Right, you've got to have a strong psychology that allows you to abide by your rules. Okay, if trades break your rules, or if you trade against your rules, you are bound to lose in the market because you are led by emotion. Okay, learn to stick to your guns. Right, and that's the particular lesson we have for this episode. Right, if you found this video to be very insightful and you found it to be adding knowledge to how you understand the markets, please do like it. And if you'd want me or you'd like me to review a particular currency pair in the next episode, please do drop your suggestions in the comment section of the video. Right, if you haven't subscribed, please do subscribe. And while you're in the process of subscribing, and if you have already subscribed, please do hit the bell notification icon so that you can be alerted the next time I upload a new episode. Ladies and gentlemen, thank you for joining me for this episode of Market Replay. I'll see you in the next one. Cheers.